Welcome to today's continuing education session. So I see we've already got over 100 people and we have quite a few more registered, so some are probably still just coming in. I'm really excited. This is the biggest group that we've had so far for one of our continuing education sessions, and I've been watching the names of people coming in and recognize quite a few who have been at our other sessions, which is just great. We have a growing CFO community. If you're not familiar with that, a group of people looking at CFO services. It does include a Slack channel that's very active. So that group, we've got more than 100 people who have signed up for that. We're sharing topics and questions, things around tools and processes, marketing, book club. If you're part of that and not active, I would really encourage you to be. It's really strengthened when more of us get on, but you will see a lot of activity in there. If you're not sure what I'm talking about, at the very end of today's session, I'll tell you how you can join that group. We've got a special offer for that. So on to today's topic, profit-focused accounting. You, like me, have probably been in classes, conferences, and other things where we continue to hear our clients really don't need us to explain the history of how their business is done. They have the tools to do that themselves. What they're looking for is an advisor to help them how they can reach their goals. So that's a huge part of today's focus. And so that's where we're going to get to. So let me jump into one administrative item, and then we'll jump to our speakers. Okay, so today is one CPE credit that you can get. If you attend and answer the 3 polling questions, then you'll get credit. We will send the CPE certificates by email next week. We do have a questions function, and we use this pretty actively during the session. So as we see questions that look like they're pertaining to this part of the conversation, we'll interrupt the speaker and ask them that question. We will also answer questions within the question sections. You might get an answer that way, and things we don't answer, we'll try to take over to the CFO community and continue the conversation there. So we really encourage you. That's a great way to participate. The replay of the slides and an email will be sent tomorrow. So in case you miss some of the polling questions and you're not going to get an automatic certificate, you can always watch the session and consider it self-study to get your CPE credit. Okay, so if I introduce our speakers today, we've got 3 really good presenters today. Jody Grunden is one of the co-founders and the CEO of Summit CPA Group. We also have Adam Hale, who is his co-founder also of the firm, and Adam is our Chief Operating Officer, and Jamie Naw is our Director of Accounting. So welcome, guys, and we're looking forward to a really good conversation.
Thanks, sounds great.
Okay, so let's start off with a quick video that kind of gives a description of one of the analogies that we're going to use for today's session.
Jody and Jamie.
But Dora, how do we get to the little blue tree? Let's stop and think. Who can we ask for help when we don't know which way to go? The map! The map! The map, that's right. The map can tell us how to get to the little blue tree. I need your help. Could you check the map and tell me what it says? You have to say map. Say map. Say map. Louder!
If there's a place you gotta go, I'm the one you need to know. I'm the map. I'm the map, I'm the map. If there's a place you gotta get, I can get you there, I bet. I'm the map. I'm the map, 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 I'm the map!
Okay, so we force you to deal with that. We're going to share, okay, I'm going to get 2 polling questions. Hopefully that gave you an analogy when you hear about the map. This will be your image, or there's a song stuck in your head for the rest of today. I'm going to start with one of the polling questions because we want to get a little bit of understanding of who our audience is today. So if you answer this quickly, and then we'll go ahead and talk about who's here, and I've got 1 follow-up question for that. So hopefully we got a really easy, quick question to get started with.
I told my wife I needed quiet time because I was going to do a webinar, and then I think she heard the Dora coming from my computer, and I just got the strangest look as she walked by my door, like, okay, working hard again.
It's not uncommon to have Dora coming from your office, though. Sorry, Adam.
I know, that's why I say, I don't know what the deal was.
Okay, we have about 80% of the people voting so far, so I'll give about 15 more seconds. So please get your vote in and we'll quickly look at the answer here and then we'll jump on to the other polling question. Okay, so I'm going to close the question down in 5 seconds. Okay. So if we look at the results, it looks like 2/3 of our people are owners and partners of the company, with about 15% being senior manager or other type of leadership. And then we have 11% of the people who aren't currently with a firm. So welcome to everyone who is here. Let me do the other one quickly. And for some of you who are not in a firm, this won't apply, but there's a question you can answer for this. Okay, so if we're talking about a firm, just help us understand kind of what size of groups we are looking at today.
And if they're not with the firm, just pick one. The number one.
Oh, yes. Yep. Yeah, that's fine. Or maybe pick 50 plus if you're with that, since that's probably a little bit smaller group. Yeah, I thought we had added a not with a firm question. Okay, about 5 more seconds and we'll go ahead and close this one down. Okay, closing it now. Okay, so in kind of the 2 to 10 is about half of our participants that are in there. I guess 75% you would say is less than 10 people of our group. About what I expected that we would have in there for that group, but welcome. So let's see, guys, can you still see the slide now? Is that right?
Yep. Mm-hmm.
Okay. Okay, so Adam, do you want to talk about the beginning of what is profit-focused accounting?
Yeah, so the map for us is the forecast, as you'll see, and I'm going to apologize twice. Once because I'm going to read to you this slide. It's super important, so we just want to make sure that everybody has the foundation. And the second apology is I'm the one reading it to you, so hang in there. It'll be over shortly. So, okay, so profit-focused accounting is a system designed to help a client accomplish their financial goals by breaking down their revenue into non-financial drivers. Unlike revenue figures, non-financial drivers can be consistently controlled and monitored through clear metrics that are then used to determine a client's revenue forecast. Finally, the amount of expected revenue in the client's pipeline is used to inform and adjust the forecast. We'll kind of walk through all these different pieces. And then a little bit more reading on the next slide there, Tom, just to kind of wrap it up.
Yep.
There we go. So when implemented, the profit-focused accounting can be the difference between pointing a client in the right direction and giving them a map of how to get there, a navigation system, and a list of the detours they'll encounter along the way. So again, the forecast is really our map, and we'll dive more into kind of that analogy throughout the rest of the conversation.
Yeah, so when we're talking about profit-focused accounting, like Adam mentioned, we're talking about 4 main areas. The first area is cash, and I'll be covering cash, basically setting the goal where we need to go to. The forecasting part is the part Adam's going to cover, and that's going to be how do we get to that determined cash need. And then Tom's going to be talking about more of the financial metrics and basically how do we monitor it along the way? How do we make sure we're on the right path, going in the right direction? And then finally, Jamie's going to wrap things up and come across the finish line with the pipeline, talking about, hey, now we've developed this great forecast and it looks like things are going well. Do we have enough business in the future to sustain the level that we need? So it's going to be accomplishing all 4 areas during this conversation. So let's go ahead and get started and dive right into cash. Purpose, as we talk about cash, the purpose is to identify a goal. So you might have non-financial goals, like maybe you want to sell the company, or maybe your client wants to sell the company in 3 years, or maybe the client wants to get get out of debt in 3 years or 2 years or 1 year, or maybe they need to build cash to prevent from, something happening like a safety net. And so we have to identify the reasons why the client wants to get there, and then identify the amount of cash needed in order to accomplish that. So really everything revolves, pretty much around cash and how to get to that cash goal. How do we deal with this as a firm? We do two different things. We meet with clients on a weekly basis to cover their short-term cash needs if they decide they need that level of service, where we can meet with them and cover the next 12 weeks. Or we can look at more of a monthly look, and this is more of the cash look, on what we need to have through a monthly cash flow management meeting, which is pretty much tied into our forecasting meeting, where we're looking at and saying, hey, here's where we're going to be at in November. Here's where we're going to be at in December. Are we okay with that? Are we meeting our cash goals? Are we on the right pace? All that's discussed within those meetings. So it gives a pretty good strategic conversation to the client by identifying the cash. So if you want to move to the next slide there, Tom. The biggest metric that we use for all clients is we want them to be in a 10 to 30% of annualized revenue in the bank at all times. So meaning if they're a $3 million client or a $300,000 client, whatever it is, take that by 10%. That's the very minimum that we want in the bank at all times. So a $3 million client, you'd want at least to have a $300,000 cushion in the bank, and then up to 30%. And then how do we determine whether it's 3 or 30%, which is on the next slide? We identified basically there's about 10 or so key areas that we look at to determine, hey, which level do they fall on? Now, there's not a scientific rhyme or reason. It's not like if you get 2 over here, all of a sudden you're at 12% or 15%. If you get 3 on the right side, you're closer to 30%. It's more of a, hey, here's where we're at. And it's a pure discussion with the client, because ultimately the client's got to come up with, hey, how much do we actually need in the bank to make sure that if something major hits our company, that we have enough cash in the bank to meet those needs. And so in looking at that, what would fall within a 10%? So when we look at our clients, if they have high recurring revenue, well, they need more towards 10%. 10%, if you do the math for a service-based company, is going to equate to about 2 months worth of expenses, and 30% is going to equate to like real close to 6 months of expenses. So again, it goes between 2 to 6 months. So if we say they have a lot of high recurring revenue, then maybe they need closer to 10%. If they have 0 accounts receivable days, meaning that the higher accounts receivable days they have, the more cash you're going to need, because to basically keep your working capital strong. If their pipeline is consistently strong, then closer to 10%. Younger partners, we're not buying a partner out where we need to actually store some money aside, 10%. Low growth, if you're not growing, then you probably don't need a ton of money in the bank. 10% would be plenty. If you got a high growth, I would say closer to 30% to allow for that gap there. No big purchase in your future. One owner. Owners having high personal liquidity. If your owner has a high personal liquidity and they can put money in the bank, well, that's a lot different than if the owners don't, or maybe you've got multiple owners, as in the case above, where you'd have to go through each owner and ask them for a cash call, and that would be pretty strenuous a lot of times, and it would again, depending upon that 10 to 30% margin. No clients greater than 10%. That's pretty standard with the banks. High amount of accounts receivable or low amounts of accounts receivable. So again, looking at the different factors, you really kind of have to line them up and determine, how much cash do we need, for one, to just basically to be a business, and then even further than that, going down the road, looking at all the big purchases, what is life going to treat us, down the road? Are we looking at a buyout of a partner or something like that? And so again, we need to know how much cash we need to have at all times. So that's the main focus here, is once we've identified the cash, then we can move on and create the map, as Dora said.
I think
So
what you'll
Jody,
Sorry,
go
I want
ahead.
to jump in. So I think what you'll see with all of these areas is they really create an area for conversation. And so you can see with all these questions in here and all these topics in here, it gives us an opportunity to get to know our client, especially during the onboarding phase, which for us is about 6 to 8 weeks. So, all these areas are really good questions to ask anyways. And this CAST conversation leads us to these really good questions, which helps us learn about our clients. And so that's one of the important things you'll notice with all 4 of these areas is you really have to understand the client, which is what kind of the difference between a consultant and an accountant is. We're really understanding that client, asking questions and learning about them and understanding where they're going in the future. Because all these questions aren't about the past. A lot of them are about the future. Do you plan to grow? Do you plan not to grow? What's your partner's plan? Do you plan on retiring within a year or two? All these questions are really helping us talk about the future, which is really key.
Yeah, and Jamie, that understanding also helps if you might want to change it over time, right? As clients change, then you can look and say, hey, let's adjust your cash reserve because of some particular event maybe that's happening or parts of the business.
Yeah, just to add to that though, I think that it's also so low-hanging fruit from a consulting standpoint too, because a lot of times what happens is you come in and you're asking the client what their goals are and what their aspirations, their dreams or whatever. This is an area where you can actually influence them and say, this is what you should have. Because in a lot of instances, clients are looking for direction and they don't know. So this might be one of their questions is like, how much cash should I keep in the company? I don't know. But this is also an easy spot where you can deliver what their goal should be. I can't tell you whether you want to sell your company in 5 years or 10 years or how much money you need for retirement, but I can tell you from a business perspective how much money you should keep in your company to keep it healthy. This is a really great, easy way to like consult the client and have an answer for them instead of them making up the answer.
Yeah, and I think if we look over our entire client base, client base is around, they keep around 12 to 13% of their annualized revenue in the bank at all times. So we really focus on that cash thing and to be, to not downplay the pandemic, but with our client base has really done very well because of the fact they've had cash. And so unexpected issues like this has really been a big kicker for our clients to be able to not make rash decisions, but they really kind of look through and make a good solid decision, whether it's, letting people go, laying people off, reducing stuff, or increasing, depending upon the situation. They didn't have to do it at a moment's notice.
And Jody, there's a question in the Q&A about line of credit and how does that work into this. Just for that question, basically, we also recommend a line of credit on top of this, and the line of credit calculation is actually very similar to the percentage we recommend here. So if we're saying you need to have a 15% cash reserve, we'd also like to apply to have a 15% line of credit for that second round of backup in case you need it.
Yeah, and it's net of line of credit. So if your line of credit's maxed, then you have zero cash, right? Or if you have 30,000 in the bank, you have $100,000 maxed on your line of credit, you actually have negative 70,000, which obviously is negative and not within that 10 to 30%.
Mm-hmm. But I think that's an important point. So even whenever we have clients that have $200,000 or $300,000 in the bank, we still advise them to get it. If their 300,000 was the goal, they have 300,000. We still advise them to go see if they can get a matching $300,000 line of credit. Because a lot of times that's a question too, is how big of a line of credit should I have? Same number, even if you have the cash reserve, it's worth it to spend the extra, couple $100 a year to renew, even if you're not tapping into it.
Should we go ahead and move on and talk about forecasting, Jamie?
Yep, let's jump over to Adam.
Yep. So
sorry, Adam.
Yeah, I got this one. Yeah. So, the purpose of the forecast is really to develop that roadmap, with a controllable revenue stream. And so what we mean by that is break down all the different parts of how they make money, what direct expenses they have associated to those revenue streams, and then also play out the overhead. The overhead's probably the easiest part of it. Really, the meat of it is going to be focused on breaking down the different revenue streams and really gaining a deep understanding of how your clients make money, because that's going to help them with the levers that they can kind of pull. And so in terms of a cadence, we're typically meeting with our clients on a monthly basis to go over this at a minimum. And I'll say also during, the pandemic and everything else that we've been going through, we a lot of times will come back to this on a weekly basis. So as things are evolving and changing, it's nice that this is updated and regular and very just intuitive whenever you want to jump into it and just change things on the fly. So with that, we talk a lot about metrics, and these are revenue metrics that are based also on non-financial indicators. So the first thing you really need to do whenever you are putting together a forecast, like I said, you want to break down the different revenue streams that a client has. So you want to make sure that everything's just not bulked into sales if they're selling different types of things or they have different types of services. And the reason being is because on the non-financial side, you're going to want to build out that logic. So you're going to want to start with, hey, this is how many of these things I'm going to sell at this average selling price. And you're going to break that down so they can see functionally what they need to do on a daily or a monthly basis in order to hit those revenue goals. If I just say, hey, hit $200,000 in revenue, that might not matter because $200,000 of one revenue isn't equal to, the product mix that you might have somewhere else. And B, you just, they don't understand what that really means. But if I told somebody you have to sell 62 cars at an average price of, $32,000, or you have to deliver, so many billable hours or this much per person for these different things or these different units, then they're like, oh yeah, I can sell 10 of those, no problem. And, I have an elevator client that he had 4 different types of elevators. They had different costs associated with them, everything. I said, you need to sell 3 of these, 2 of these, 4 of those, and 1 of those. And we tracked that on a monthly basis. And he literally just like, as he was going, he knew where he was at because he was able to do that. So, so that's an important part to start. And then you can do the direct costs associated with those revenue streams. And then at the bottom, that's like I said, you can kind of fill in the overhead based on what they've historically done and set some budgets.
Yeah, so basically what Adam's saying is that they can control it. Like we talked about before, if you throw numbers out at people, they're kind of blinded by it. They don't understand how to get there. But if you break it down into non-financial indicators or non-financial drivers, that's when Adam mentioned that, hey, now they know it. The elevator company knew that they're going to hit their revenue because they sold those 5 different things in that order, or real close to it. They knew what their revenue was going to be before we even put the financials together to compare it. So that's the big key there, like Adam mentioned on the production metrics.
And I can tell you from just working with a lot of our CFOs and having conversations about this, sometimes this is challenging for people to determine, how do I come up with this? And I think to Adam's point is you really just have to have a good conversation. The more conversation you have with the client, they're going to understand what their drivers are, and you'll get to it in that conversation. So you have to be very curious and not be afraid to have that conversation. And then, if you have an hour conversation about, what drives their business, I guarantee during that conversation, you're going to be able to map their forecast out and be like, oh yeah, obviously this is what your driver is. It's your people, or it's your number of things you're selling, or anything like that. So it is really good happening through the conversation.
Speaking of revenue, because that's kind of the things that you talk about and you're always wanting to kind of move the needle on. So 4 ways to increase revenue. What's nice about building out the forecast and building out the logic is you can change these different variables along the way. These are just some ideas. I mean, it really depends on what you're doing here, but you can obviously like increase price. You can increase the number of clients if you're, if it's like a subscription-based model or something like that, increase the average order size, increase the frequency of sales to existing clients, those kind of things. But really the idea here is if you have the logic mapped out and you have them very easy where you can just kind of change a few things, you can show the client how they can navigate an increase of profitable revenue. And then what that ultimately impacts to the bottom line on the P&L, and then ultimately back to the cash in the bank. So, you'll sit down with a client and they'll say, hey, I'm doing X amount of these and X amount of those. And you can show them, hey, you get a little bit more profit on these. And if we can change the product mix from 50-50 to 60-40, this is what it would mean at the bottom line at the end of the year. People are like, oh, well, that looks really good. And this is what it means to cash. So being able to do that is important.
Yeah, and so the conversation becomes, hey, we need to have, let's say $1 million in the bank or $100,000 in the bank, whatever it is as of December, and you're leaving the meeting saying, okay, so now that means you got to sell 5 of these, 3 of these, 2 of these, and you got to sell consistently over the next month, or the next 3 months or 6 months or whatever, and then the client's leaving with an idea that, hey, I've got a game plan. I can actually do that. I can break it down to where I can sell those vehicles, or if it's trucking companies, the miles, or whatever their drivers might be. Breaking it down to those non-financials creates that strategy and that story that they can actually go out and visualize and achieve. Because keep in mind that most owners of businesses, they don't have a PhD in accounting. They are a great plumber, they're a great electrician, they're a great truck driving company. A lot of times they just kind of fell into the business, and they started out as a contractor, then all of a sudden now they have employees, and they're kind of like, I'm not 100% sure how we're doing it. So they just kind of increase prices until they get to a point where they actually are bringing in cash. Whereas with this, it allows them to actually sit down and more understand what their drivers truly are. It's amazing how you go into a lot of clients and all they do is they want to beat the top line revenue number. They want to say, hey, I just kind of go revenue, and they're continuously revenue, but their cash never increases ever. And that's the important part, is identifying what those drivers are and making sure that you're matching the costs associated with those drivers for sure.
Yeah, and we're talking about all good stuff here, but I mean, we can have it the other way around too. Like some people just have bad models. I remember early on in my career, whenever we were doing this, and I had this lady, I felt so bad for her. She was in tears by the time she left my office because she just had a bad business model. She was operating a creamery, and I broke it down to how many scoops she would have to do on a daily basis and a weekly basis, because she just kept saying, yeah, I can get to that revenue. I can get to that revenue. And I'm like, okay, well, walk me through this. How are you, we went through the variations. And whenever I laid it out to her in a non-financial way, she's like, there's no way in hell I can do that much. And I go, I know. That's where we're going with this. And so, and I was like, so this, she goes, but I've been doing it. I go, yeah, but you've been putting money into the company. You've been working 90 hours a week. And you're not drawing a paycheck. Like here's the reason why. Here's what would have to change. And I showed her financially what would have to change in order to make that happen. And she's just like, that's just impossible. And I said, well, you have two options. Like you can either solve for it or not, but I'm just telling you, that's the reality of it. She went out of business like 3 months later. She left going, she was in tears, and she's like, hey, no, I think I can handle this. I can do it. I can prove you wrong. And I was like, hey, I wish you the best of luck, that kind of thing. But like, I'm just telling you, if you want to dig out, this is how you dig out. And like I said, 3 months later, she'd pitched it in. Whenever I saw her, she's like, I just couldn't keep working 100 hours a week. So like I said, well, yeah, not employed.
I know it's not the last.
One of the key things you're describing, Adam, which is part of what we do, is when and let's say that her number of scoops is correct, that actually is part of your forecast. It's not in the back of the napkin where you do it and then turn around and say, okay, then you're going to bring in X revenue per month. That's in there. So as she goes forward to the next month and says, okay, realistically, that number of scoops comes down, then you adjust it down, and it's flowing through. And so that's a really key part of those non-financial parts that are in our forecast.
And then you measure it afterwards too. So like if you think you're going to have 1,000 scoops in 1 month and you only had 600, that's part of the conversation. Is okay, you only had 600 last month. How are you going to get to 800? How are you going to get to 1,000 this month? And so it is part of that conversation, and it's part of those non-financial metrics after the fact to make sure you look at it, evaluate it, because we're just providing the numbers. They know maybe the shop was closed for 2 weeks and that's why they only got 600 scoops that month. So they know that information, and you're just providing the numbers to spark those conversations.
Yeah. That's a perfect lead in, Jamie, I think, into the financial section. So if we talk then about reviewing financials with clients, that really is managing the forecast by reporting on how we're doing. As I said in the very intro, most of our clients don't need us to tell us what happened. And most of them are sophisticated enough, they can go into their own accounting system. And when we review the financial, they've already looked at it. They know where the sales are. They know where their net income is. Where they really need help is, how am I doing compared to my forecast? And how did I do on those non-financial metrics that I understood so well? Where you can then go back and say, just like Jamie was saying, it's because we had this many and that was short of the forecast, or we sold the right number, but we sold them at a different price than what we explained, or it's a different mix or something that's in there. So how is the company doing relative to the forecast? That you can imagine leads right back into a good forecast conversation to say, if you exceeded the forecast this month, what does that look for next month, and should we adjust that? So that non-financial information ends up being really important to be able to tell them a story about what happened in the month, not just the financials themselves. So in our process, that's a once per month meeting that we've done the forecast, and then we're coming back and saying, okay, so here's how you did last month. Let's make sure we have a good understanding of that, and then we can continue on the process and keep doing forecasts. One of the other things that we're bringing to them then is, how should you be doing? And we have a really strong focus around our gross profit and our net income metrics. So two really key parts of their business to talk about. If you go operating expense, like Jody mentioned, that's usually a fairly straightforward and pretty easy way to talk about. The gross profit is usually not quite as simple, but that's where these metrics come in and say, so how did you make money, and how much did you make from that portion? And then was it enough to cover your overhead and the profit goals that you had? So that's a really important part of the focus that we have just around the financial parts. And then we also use a fair amount of information about just where should you be. as you have probably had the same experience, start showing people benchmark information about comparable companies and they get really excited to see how they're doing. And as you can imagine, companies are different. So we're showing a couple different industries where you would say if it's an electrician and they're hitting a 50% gross margin, they're doing really well for an electrician. But if you just have one standard for all your companies and it's a higher gross margin, then you're going to be critical of them when you shouldn't be. Otherwise, restaurants, others are doing much better than that from a gross profit standpoint, but it's a great way to compare them across the clients that we have that are consistent. We've got some of the non-financial metrics also. So then we can say, okay, based on some of these other measures, here's how you're stacking up against your competition, which can be really good conversation where we've had clients who have said, I can't change that, I can't influence that until they find out that all their competitors are doing better than they are. And all of a sudden they're a lot more motivated to say, okay, how might I be able to make some changes to those things?
Yeah, I would say the biggest thing here is that knowing what your gross profit is and then knowing the conversation that you're going to have with the client. So if you're at a fast food restaurant and you're looking at a net income of 5% and they're hitting 5% pretty regularly, that's a great thing. If they're hitting 4%, then maybe let's look and say, what does that 1% mean in our cash picture? Maybe that 1%, if we can make that up, we're going to get to our cash position, a lot quicker, kind of getting back to the forecast there. And so it's really important to have that conversation. So maybe the gross profits, 66%, and maybe everything's dialed in. Then you're looking at the simplified financial statement where you're looking at admin costs bulked in, your marketing expenses bulked in, and then your facility expenses bulked in, and you're looking at marketing, and you're just spending an ungodly amount of money on marketing that's not driving the revenue that you expected. So maybe there's a look back there and look at our different marketing methods and say, hey, how can we better market to get the revenue drivers there? Or maybe it is the gross profit. And 99% of the time, that's where it's at gross profit. They're falling short there, either in labor or in materials if it's a material driven company. But it's important to know what that gross profit is. So again, you have the knowledge behind you, so you can instruct them on, hey, here's the areas that look weak, and let's figure out now how can we shorten up the gap. If we're 64% or 80% or whatever the number is, how can we get it closer? We might not be able to get exactly that average industry analysis, but again, closer. But as Tom was flipping around and talking about, we're always comparing back to our forecast. So if we're forecasting at 60% and we're hitting 66%, well, high five, we're doing a lot better, and maybe we should adjust our forecast to 66% going forward, not the 60. Or if our gross profit is 50%, then, and we had in our forecast that Adam put together there based on industry knowledge, based on what the client thought, and it's 16% off, well, that's really distorting our end goal. And if we need to adjust it, we can do one of two things, right? Adjust that forecast, or we can figure out a way to hit the numbers that we pledged that we were going to hit. So that's the important drivers, I guess, around this, is to know where you're at, know what the industry numbers are. We pulled these right off of ProfitSense. That's a tool that we use to pull industry data. There's a lot of different tools out there. That's not the only one, but this gives you a pretty good idea, a quick look up and saying, yeah, full service restaurant, that's my client. Here's what they need to be, or coffee shop. Completely different scenario, smaller net income. That's what our net, that's what our industry standard is. How can we make sure that we're at least achieving those numbers?
And Jody, you just answered the most frequent question we've been getting. Hey, where are you getting these industry numbers? So ProfitSense is one that looks by industry and will give these. You could also look in trade publications that you have, so if people are in trucking, you can say, what are the publications that they're saying? We happen to have a lot of clients in the same industry, and so we actually are looking across our clients and saying, what are we seeing in there? But if you're wanting the quick answer, ProfitSense is a really good way to get that kind of a benchmark.
And there's
ProfitSense is a good selling tool too. Like right at the beginning, they have like a little quick hitter that'll give you all kinds of metrics and industry background if you go into a client engagement.
For sure. And there's another good question in there. It says, do you help the client develop the business plan to accompany this profit focus? Exactly. That's exactly what we do. So a lot of companies come to us and that's what they're looking for. We're using the numbers to guide the conversation. So what we'll do is we'll look at their previous income statement. We'll look at it for the last month, the last quarter of the last year, and we'll really understand where their percentages are coming in. And then we'll use that to guide the conversation of where do we want them to come in. Right now, you're only making 2%. here's what your cash is going to look like if you make 2% over the next year. Is that what you want? No, let's try to bump that up to 5%, 10%, you know, so we can actually grow your cash and grow your business. And really it's one large bucket. If you look at your revenue per month, that's your bucket of how much you can spend. And every company is a little different. You know, we work a lot with the digital marketing space, and a lot of companies will come in and be like, we need our marketing budget. Our marketing budget is the most important thing to us. We need to spend 30% of our revenue on marketing. We'll say, okay, great. But if most companies only spend 10, we need to find that 20% somewhere else. Are you going to pay your employees less? Are you going to spend less on your actual tools of the trade or whatever that is? But we really do work with them on developing that plan, and it's their plan. We're just helping them by giving them the numbers that they've used in the past and building them a forecast so we can track, are they keeping up with what we're talking about? And so that's definitely really kind of the key to what we do, is building that forecast and then tracking it each month. And then again, sometimes it changes. Sometimes they say, oh, this 30% marketing isn't attainable. We can't do that anymore. We need to jump down to 25%. That just gives us a little bit more margins on the bottom line. So that really is what we do.
Yeah, and so looking at this, we're providing monthly dashboarding where a client can look at the non-financials fairly quickly, or the key areas. But when we talk about the financial state, we have that meeting once a month. That's typically about 15 minutes of the meeting. We're just kind of reviewing the main areas that they missed or hit, and then how that impacts going forward is the remainder of the conversation. So the next 45 minutes, we're talking about, okay, so now because you had a really bad July, you know, here you're going to fall short now in November. You may have to lean on your line of credit. Are you okay with that? And then no, they're not. Then we need to make some adjustments. Or yeah, I'm okay with that because I know it's a short term, and then we're going forward. And so that's the type of conversations that we have, and clients really want that strategic consulting, and that's what you're doing. You're teaching them how to actually run their business without basically running their business.
So Jamie, as we look forward in the forecast next several months, and you're telling people, what do you think your sales are going to be? Pipeline becomes really important in doing that. Do you want to talk a little bit about pipeline?
Yep, let's go. Yeah, so pipeline is what we use for our clients. And so a lot of our clients are a sales-based company where they have to have a sales department, and they're selling large projects and large contracts. And so they're using the pipeline for that. But really what the purpose is here is we want to make sure that the forecast that we're outlining, especially for the next short term, for the next 3 months, for the next 6 months, that it actually makes sense with what's going on out there. And so that's really the purpose of these pipeline meetings, is to talk about, yeah, we have goals, we have an idea of what we want our capacity to be or what we think we need to do, but what does it actually look like? And then once we know what our revenue actually looks like, we can actually make adjustments elsewhere. So if we have this meeting, and we have this meeting once a month, so we do a revenue rec meeting as well as a pipeline meeting once a month, and in this meeting we're going to come up with an outlook. And if the next 3 months look really slow, we put the question back on the client and say, your revenue looks like it's soft. Your revenue looks soft by $100,000 these next 3 months. Are you okay with that? Because we have a cash reserve in place, we're willing to live with that, or maybe we don't have our cash reserve in place, so we need to make some decisions. Do we try to lower pay? Do we need to let go of people? Do we need to cut our marketing costs, or whatever it is, so we can make sure that we know with that lesser revenue that we're still going to have a good plan in place. That's the purpose of this pipeline meeting. Over the next slide. And so again, what is that metric? This is probably the broadest of all the ones. It really depends on what the company can look at for the outlook. So again, like I said, we have a lot of sales companies. And so if you want to go to the next slide here, Tom, it gives a couple of examples here. But a lot of our companies have sales teams. And so it's really easy for us to look at an outlook. And so what we do for our companies that, again, are more in that pipeline space where they have a pipeline to work with, is we look at it 2 ways. One, we look at their pipeline and what it should be based on what their revenue is. So for example, if they have $300,000 of capacity over the next 3 months per month, and they already have 95% of that under contract, their pipeline doesn't need to be very large because they're not really worried about these next 3 months. But if it was the opposite and they only had $50,000 under contract for these next 3 months, they would need a much larger pipeline calculation. So we've came up with a calculation that we can do with that, and really it's just based on a commission person. It's based on a commission salesperson's how I would run if I was a commission person, what kind of pipeline I would need in order to hit my commission goals. And so we kind of modified that calculation to come up with what we expect the pipeline to be. But again, if we wanted your pipeline to be $1 million and it was only $500,000, this would lead us to those really good conversations we want to have. What should we do? How are we going to handle it these next 3 months if we have a negative 20% loss? Do we need to adjust costs now? Because it's a lot easier to adjust those costs when you're 3 months out versus live in the middle of the month. So that's the whole purpose of this. And the other calculation we use is something we call contract capacity. And so basically this is looking at historic data. So going back to that same number I gave, so let's say we're at 90% of contract right now, and traditionally we catch up 30%. So if we have 90% already under contract and we usually catch up 30%, we might need to actually hire these next 3 months because we're not going to have enough people to do the work that we're going to win. And so that's what we want to look at with this contract capacity number, is kind of look at it from a different direction. Yeah, the pipeline really helps us out. What the contract capacity does is it gives us the ability to say, based on historic numbers, how are we going to perform? And so that's currently how we do it for sales teams. But again, not everybody listening to this call and not all of our clients are on a sales team basis. So we really, the goal here is to find some way to figure out what the next 3 months are going to be. Sometimes it's based on seasonality. You know, obviously we go back to the ice cream shop. We know the summer is going to be really good, you know, for the ice cream shop. So we know the seasonality looks good. We know the marketplace where you are is, if you're in California and it's really hot and there's no COVID restrictions currently, it might be good. If there are COVID restrictions, people can't go to the ice cream shop. Obviously, we need to adjust our forecast because the revenue is not looking good. So there's a lot of different analysis you can do. But I'd say the key here is have a formula, have a calculation, and so you can give the proper advice to the company of how the next 3 months look. And that really is the key to the pipeline discussion.
Jamie, we have gotten a question about how we factor in seasonality, and you mentioned that. Do you want to talk about how
so
that aren't consistent?
Yeah, so for seasonality, again, what we look at, especially I'm going to go back to our examples, is so what we do for our companies and our clients, a lot of them in that sales space or in that digital marketing space, is we look at their capacity. And so what we'll do is we'll throw in there the holidays. So with seasonality for any time where you're looking at employee-based revenue, is if November and December are always going to be a little slow because people take a lot of vacation, they take a lot of holidays, and then in addition to that, just the sales cycle slows down a little bit. So that's how we build into the seasonality, is we basically look at the capacity and we'll reduce the capacity and say, normally we have $300,000 a month to work on it, but now we don't because we only have
Tom, you're sharing
2/3 of our staff working.
Sorry.
Yeah,
There we
you're
go.
bored with Jamie.
Yeah.
I was trying to look up an answer.
I would say the other thing is with a non-sales team, you know, in terms of seasonality. So one, our forecasting software has it just built into it. So you can actually click a button and it says seasonality. If it's like a retail place or something like that, and you're just going percentage of sales. If you don't have, that's, you know, again, for retail where maybe you don't have the metrics or the non-financial things built in, but then on the non-financial side, you can do the same thing. So if you normally, so for instance, I have a trucking company that I work with, and we know we move a certain amount of moves, and there's total seasonality during the summer for that. We have our annual moves spread out seasonality based throughout the course of the year, so that we have it spiked at different times. So that's how we handle seasonality. And then on the economic side for COVID, a good example is, you know, I work with a doc office, and they knew they were going to be closed for a certain amount of time. And so we'll go into the forecast and just plug in, okay, next month we're going to be at 25% revenue, then 50% revenue, 75, then 100. And they can see how their end of the year revenue is going to still look like. They knew what their end of the year profit's going to look like and their end of year cash. So I was showing them, hey, like your end of the year distros and taxes and all that kind of stuff during the COVID, you know, shutdown period. And they were like, oh, this is great. So we don't have to do anything, basically, is what you're saying, because we had a cash reserve, we had all that stuff, and good meeting. They felt good, and they hung out on their time off and their close down period. So.
Adam, we've just gotten a couple questions about what software we use for forecasting.
Plan Guru. So Plan Guru is our tool. Yep.
Yeah, so Plan Guru is used for long-term, and then we use cash flow tools for short-term cash forecasting. So those are the two main ones. Finograph.
Yep.
Jody, you want to talk about these coming together again?
Yeah. Tom, I think you got your oddball thing up there.
Your reminders are popping up on there.
So when we to kind of circulate to again create that full circle there, we have to start with identifying what the client's needs and wants are, and that's the cash position. How much cash do we need to have? Not only 12 months from now, but every month building up to that, because it's really important. You might have if you're forecasting cash at 12 months from now, but you're negative all the way up there, you probably won't be in business to get to that 12 goal. So it's important to make sure that when you're forecasting, you're looking at least a 12-month look all the time, identifying the cash need, and then showing the client, hey, here's where we're at comparatively, and here's when we're going to hit to that. Again, we use a 10 to 30% range of annualized revenue to determine, hey, here's a safety net that may increase or decrease based on the needs of the client. And then from there, we jump and create that forecast that Adam mentioned, which is super, super important, because now we're identifying the map, how to get to that end goal. You know, what revenue do we need to have? What product mix do we need to have? You know, do we need to look for other forms of revenue in order to generate, you know, that money? And maybe what we're currently doing is not enough, or maybe we're not growing fast enough for what we want to achieve our goal. So that's where the forecast really comes into play. And again, that's a dynamic forecast. It's not one of those things you create at the beginning of the year and you never look back at it. It's something that you're making adjustments on a regular, monthly, weekly basis in some cases, depending upon all big decisions. So our team will always come back to the forecast in any big decision. You know, whether our meeting is, you know, maybe in 2 weeks, but they've got a big decision to make. They're talking to our team and walking through what the ramifications of that big decision would be. You know, one big thing is, you know, just simply giving pay raises across the board. You know, how's that going to impact my cash? You know, if I give everybody a 5%, what's that going to be compared to a 10% or a 2%, or maybe I have a mixture, you know? So all these different things play into those decisions that before you as the consultant was there, they were just randomly doing it and then suffering the consequences, not knowing what happened there. Now they're actually they're more in an informed decision. They're helping solve that problem. Then going to the financial statements, the financials are just simply there to show them where they're at compared to where they should be on that forecast. And so, you know, if they're looking at having a loss next month and they're forecasting a loss next month, we might be high-fiving because maybe the loss isn't as big as what we thought. Or you know, it's kind of funny how all that works. But basically the financials are there, and they should be simplified in a manner that the client can understand them, and so that you can spend, you know, again, 15 minutes going through all of them very quickly, hitting on the main high points and showing them, hey, based on this, here's where we're here's where we're going, you know, going forward. And there's a lot of different really cool dashboarding programs out there. I would definitely look at investing some time and money into one of those programs to help you as the client, so you can actually convey that to a client. Because some people look at numbers, understand numbers. Other people look at graphs and charts and like those better. So again, it's important to be able to offer that to both clients there. And then as Jamie mentioned there with the pipeline, you could have a great cash position today. You could have the forecast based on capacity and everything's looking great and the metrics are showing it that way. But if your pipeline is non-existent, that's a huge red flag. And so again, the pipeline is just as much key to all these metrics as what, you know, cash forecasting and financials gives to a client. And so that kind of wraps it around that full circle of events there. And so we talked about, you know, hey, we have a meeting for this, we have a meeting for that, we have a meeting for that. You know, how many meetings do we actually have? Well, if you've heard us talk before, we have typically with our clients, based on the client engagement there, at least 1 to 2 meetings a month. If they're looking at just simply a financial statement forecast, if we're part of the leadership team, we're meeting with them weekly and sometimes even twice a week, to where we're actually going through a meeting with them and being a really integral part of their team. And that's the biggest thing, you know, about this whole consulting process, and something we've been doing since 2004. And so we've been doing this a real long time, trying to fine tune it and breaking everything down. And we found that this is the easiest way and best way for a client to go from A to Z without having to, you know, have all the different speed bumps along the way there.
And Jody, we have gotten a couple questions about tools for reporting that you just mentioned, kind of how to pull everything together. So we talked a previous time about reach reporting is one that we're using. And so that can pull in your forecast information. It can pull in some of your non-financial information. Of course, financials together into some graphs in a really good way to describe to clients what the information is that they need. We'll answer in here also, people have asked about the cash flow forecasting tool. Finograph is the name of that, and I'll put that in the answer so people can see where that one is. We did get a related question, Jody, though. If you're spending once per week with clients, how big is the client load that you have on CFOs and maybe seniors?
Yeah, I'd say typically when we first started, I would say typically a normal client would be between $300,000 in revenue to about $1 million. We're meeting with them typically on a monthly basis, maybe twice a month, depending upon their situation. When they started getting over that $1 million mark, about $1.5 million, that's when we start seeing the client moving to more of a weekly one. It's when they start actually having a leadership team. You know, it's not just you and the client sitting down talking to each other. Now it's you and the client, the project manager, maybe the marketing person. You know, those people are starting to get there. And our typical average client now is close to about $4 million. So it goes from, you know, where we started originally meeting with them monthly from like a 300 to $1 million client to meeting with them more often and sometimes weekly just on a cash flow, sometimes you know, twice a week with meeting with them after that. But again, it varies on the client's needs. Also, if you've got a startup company that's well capitalized, you know, a lot of times we'll pop in on a weekly, you know, meeting with them to really help them get things going, get them, you know, get things started, and you know, be part of their growth.
And I answered this in the chat, but just
let me interrupt for just 1 second. I'm going to go ahead and launch the last polling question, and then Jamie, if you want to go ahead and address that question.
Yep, I answered this in the chat, but I think the question also was like, how much capacity does our team have? And so, you know, we have each team that we work on has, or each client has both an accountant and a CFO assigned to it. So our CFOs, again, Jody talked about kind of the varying needs of our client, but so it could be anywhere between 10 to 15 clients. Obviously, if they have a lot of those just monthly clients, they're probably closer to 15, where if they have a lot of those weekly clients, it's closer to 10. And then our accountants are about half of that. So somewhere between 5 to 10 clients is how many each of those work with.
Okay, good. Adam, so we've gotten a couple of questions. You know, lots of questions around the industry benchmarks, but what about industry standards for key performance indicators?
Yeah, those are harder to find. So yeah, no, those are, there are some like, there are some associations out there that say that they'll give you deeper analytics. I know there's a book that the business reference guide. It's more of like it gives you the multiples of like how you're going to sell the companies and do those kind of things. They do have some interesting data inside of them, and that's a relatively cheap book. I think it was like $300, and they put them out like every 2 or 3 years. But I think it's World IBS. They have some more detailed information on some of the KPIs, but for the most part, I think whenever it gets to the metrics in there, if you're working off of you kind of back into them. So if you're working off the financial metrics and you know what you need to hit, and then you're having the client walk you through how they actually earn that revenue, I think that you can kind of back into what those benchmarks for those metrics would be.
Yeah, I think the other part about that too is I know we have a vertical that we focus on quite a bit, and there's a lot of reasons to do that. One, because you kind of get to become experts in that industry, and I think that's been really helpful for us. Is we work with somewhere near 100 digital marketing companies, and we can say based on our other clients that are somewhat similar to you, this is where we're at. So I think we've I know not everybody's a fan of going down a vertical, but that is one of the advantages of doing it, is that it really helps you really understand that industry and not need to go out and grab those external benchmarks because you have them with your other clients.
Yeah, and I think it'd be fair to say a huge part of the value is helping a client understand those non-financial metrics that drive their business. The industry benchmarks are really helpful, but just getting down to, okay, so here's what drives it. What are you doing currently? How can we influence those as a huge part of the conversation, right? Then if you can compare and say, okay, and you're not aligned to the industry is one thing, but we can bring a great understanding of what they're doing just by that part. Let me go ahead and show the results of our poll question here. So it looks like most people, or not most, a little bit more than half the people are doing forecasting and cash targets. Not very many are doing pipeline analysis or industry benchmarks. So hopefully that part of the conversation was helpful. Jamie, I don't recall, did you mention what some of the tools are that some of our clients are using where this pipeline information would be coming from that we can use?
Yeah, so I think
CRM systems.
Yeah, it really varies. I think it's a pretty wide range. I would say that probably the most popular we see are Pipedrive and HubSpot. That's probably the two most popular we see. I don't know, Adam and Jody have a different opinion than that, but those are probably the most frequent that I see is work with those. And Salesforce. Salesforce operates. ProfitFocused. Yeah, Salesforce offers a lot more than just pipeline, so you have to be pretty sophisticated to go down that road, but we do have a couple clients that have gone down that road as well.
Yeah, and I think I would say as we work with clients, pipeline's probably the area that we end up teaching a lot of clients. That lots of times they'll say, yes, we have some pipeline information. Once you look at it, you're saying, let's make a lot of changes to the information you have so that this becomes usable it's a good view into how how good their sales process is, but one that I think they find a lot of value in making those improvements and getting the metrics good.
And there was another question in the Q&A about that as well. Is like, we talked a little bit about the companies that don't have sales departments or that are direct to consumers. And I think the key to that is really asking people outside of the accounting team or outside of their CEO team of being like, okay, what does your team look at in order to predict sales, and talking about that and how do you measure it? Because they're going to have those conversations. And then if you know how they measure it, to Tom's point, you can kind of educate them and be like, all right, let's take all this data and turn it into a calculation that's going to help us see the future a little bit better.
Mm-hmm.
Yeah, and that goes from the different associations. Like when we had 5 or 6 Burger King restaurants, they pretty much knew what their sales are going to be by the day.
Daily. Yeah, we knew
was
what Wednesday was and a Thursday. Yeah.
Yeah, and we knew if it rained out, if it was raining out, here's what the sales are going to be. And so there's a lot of information you can get out there if you really do some digging. And most often the clients will have an idea or have a pretty good grasp on what that is. If you're selling trees and it's like a nursery type of thing, that obviously your sales are going to come all within 3 or 4 months, and it's really going to depend on if it's wet in the first part of the year versus dry, where they can actually do the planning. So all that really kind of builds in, and it's really important to understand the client so that you can go in and really help advise them to where they need to be.
Yeah, let me jump and show a couple of these offers that we have for today, and then we've got 1 or 2 questions we can probably fit in before the very end.
Sure.
So I mentioned at the very beginning, there's a Slack community. More than 100 people are participating, and a lot of people in this call are in there. If you aren't aware of that and don't belong, there's an opportunity to get a 1-month free access if you use this promotion code. You can capture it here. Like I said, we'll send out the slides and the video tomorrow, so you'll also have that within there. But I think it's a really good way to keep these kinds of conversations going. There's also a new book that Jody has released talking about building a virtual CFO firm in the cloud. A lot of what we talked about is included in here, and some other answers about being a virtual firm, virtual CFO roles, things like that. So a couple really good opportunities for people to have. And pretty soon we've got a digital course coming up for what's the virtual CFO playbook. How do you try to land a $60,000 per year client in there? So a little bit of a teaser, but you'll be hearing more about that and an opportunity to really get some in-depth knowledge. So we did have one other conversation or question about, so do we only serve clients where we're in those states? And no, we'll serve clients everywhere. And in fact, most of my clients are outside Indiana where I live. All of our meetings happen virtually. We meet our clients occasionally, but most of the work does happen virtually with them.
Yeah, to kind of give you some background, we have about 130-ish clients, and I think we're in just about all 50 states. And our employee base is 100% virtual as well. So we've been virtual since 2012, 2013-ish, somewhere in that ballpark, where we don't really have a physical office space. And so our employees are virtual, spread throughout the United States in about 25-ish states. And then our clients are typically, I think, all 50 states currently as we speak. And so we're providing the service throughout the United States. So yeah, great question. And with COVID, I think this has opened up a lot of people's eyes that, hey, we can work successfully from a remote location, and clients really enjoy the experience as long as that you've got everything set up and properly put in place.
Yeah.
And we're going to address that in the VCFO playbook and that coaching course that we're going to cover too. So pretty excited about that, trying to put a lot of meat into that. So we'll walk through that journey we had to.
I got a very softball question from Anna. That I have a hard time not recommend is our book I'd recommend to read, and I think Jody Grunden's new book would be a really good one to read.
Right there, you're 25% off.
Yes, but I will say in the CFO community, there's a book club, and a lot of people are posting, hey, have you read this particular book? And people have given insights on it. And so for me, I found that to be a really good resource to just get people's takes on books and then an easy discussion for them. So
pick a book. You pick a book, Jamie. Come on, everybody pick one book.
Yeah,
on the spot.
and I will tell you the book thing is huge, because when Adam and I first started providing the service, we drew our experience, because we had no experience at that point. So we drew our experiences off on what other people had written, and so we had read ton. Oh God, I can't even imagine how many books we read over and over, and then listened to them on at that point it was tape, and then it became CD, and then I own like 3 different things of the same book now. But anyways, you know, it's really important to understand and read, because you start bringing experiences from these authors into your conversations with the clients, and it becomes very valuable. So I would read and read and read for sure.
But
So which
a
one?
quick answer,
What's your book?
Upstream by Dan Heath is one I'm reading right now. I posted that in the book club, but it's one that I'm finding really interesting and a great way that I think we can look very well, very constructively at our clients' issues.
That's Upstream.
Upstream by Dan Heath. And that is I posted in the book club, so people can see it there.
I'm gonna stay the same one that I always say, eMyth. I think eMyth really helps me understand our clients better and understand what they're going through, and helps me be more than just a financial advisor, but also help them understand their businesses and the kind of processes they need to set up. And then I know, just to plug the podcast, we do a podcast out there, and this is one of the topics we did cover was books. So Jody, Adam, and I talked for about 30 minutes on books that we enjoy. But Adam, what's your answer?
4DX, 4 disciplines of execution, by far. Lead and lag indicators. You want to know about metrics and thinking through that whole thing. Just common sense approach to business in general. I think it's similar to eMyth. I think it's really foundational, good stuff.
Yeah, one of the quick reads would be the I just lost track of The Richest Man in Babylon. Talks a lot about cash and the importance of cash, and it's written in a very unique storytelling thing, very small book, and can be read very quickly, which are the books I like to enjoy reading it nowadays anyways, is the real short,
Big
quick
print.
ones. Yeah, big print, but really great book on cash and cash flow management.
I will go ahead and post these titles on here. We also got another question that leads perfectly into our next session that was, will you have a session on hiring virtual employees? And so the next CPE event is going to be developing a high performing team, including attracting talent to your organization. So thanks for asking that question. But yes, that is one of the things that we're looking at very closely.
Yeah, and
But
that
we're
will not
going to be taking next month off. Yeah.
Yes.
So
Thank
we're
you.
going to be
That'll
taking
be
next month
October.
off because we're focusing on the VCFO playbook course. So that'll be in the middle of October, the week of the 15th, I think.
Mm-hmm.
And Tom, one question I want to address, it wasn't really a question, it was more just a thought, but I think it's really important for us to address this. Someone just talked about, you know, how they do stuff similar to we do, but they like how it's simple the way we do it. And I think that's one of our keys, is we really try to make things, because a lot of times finance is intimidating to people. And if we were there trying to act like fancy accountants and try to be all smart with what we're talking about, they would look at us like we're crazy. So what we've tried to done is really simplify our topics and say, okay, these are the 4 things you need to focus on. This is what they are. And then once they understand them, how do you be successful in those areas? And so that's really what we try to focus on. And we recommend that for anybody, to try to really simplify things. And, you know, you think of like a Dave Ramsey, even if you've never worked with Dave Ramsey, you know exactly what his things are, you know what he focuses on, you know what his areas are, and that's the way to do it. So I would definitely recommend anybody in this CFO model, have your platforms, focus on those platforms, and make them simple enough that you can explain them to a 10-year-old. And that's a really good way to run a CFO.
Because the key there is you want to make everything very repeatable. The repeatable part comes with, so you can actually scale. If you make it very difficult where you're the only person that can explain something, it's really hard to scale that. But if you can break it down, make it simple, where you can actually teach people how to do what you're doing, then you can scale within your own business. And that's a big part of making it simple.
And Adam, I don't think we have an answer to this, but we've gotten a few questions about any timing on the virtual CFO playbook course. What are we saying in general around timing around that?
We're hoping for the end of September is kind of what we have it all mapped out for. So could be mid-October, but we're going to try to make sure that's in place by late September, hopefully.
Excellent. Okay, well, thank you. Great participation. We love all the questions that people are getting, and we're getting lots of nice compliments about people enjoying today's presentation. So thanks for that. We hope to see you over on the Slack community, and we'll be back together with another CPE session in October, and definitely hope to see you there. Thanks, everyone.
Yeah, thank you.
Thanks a lot.